All right, let's jump into strategy number 1. We are calling it the weekly income iron condor. So how does this work? What's the trade setup? Here's what we go with. On the trade entry, these are going to be set up differently than our monthly iron condors. When you get down to the week of expiration, these options are priced differently. The theta component works differently. The gamma, the delta, all the Greeks, everything works differently. And therefore, you have to set up and manage these trades differently. And we're going to show you the way to maximize those gains and minimize the risk. So here's the trade entry. We are selling the 40 delta calls and puts. So that's tighter. That's closer to the money than our traditional monthly iron condors, where we're traditionally going out around the 20 delta to sell. We're selling, in this case, the 40 delta, which is closer to the money. And our wings that we're buying, we're going way out to the 10 delta. We're selling the ones closer to the money, and we're buying the wings further out. Okay, this is almost an iron butterfly, but we're not sharing the 50 delta strike. We're not sharing the same strike. We're spreading that out a little bit. So we're selling the 40 deltas, and we're buying the 10 for that defined risk. Okay, so when we enter these, we're going to choose the expiration cycle that has between 6 and 8 days to expiration. Okay, 6, 7, 8. The most common that I like to enter these on is 7 days to expiration, but depending on kind of where you're at in positioning different trades, between 6 and 8 days to expiration is cool. Then the last note is, I mentioned, we like to enter these on a day when implied volatility is expanding. And the reason is because when you sell an iron condor and you collect a credit for that, that position benefits from implied volatility contracting, right? You benefit from an implied volatility contracting. So if we can put this on a day when implied volatility is expanding, then we're looking to hopefully get a little bit of a benefit if it does contract during our trade cycle, and we'll benefit from that. Now, how do you know when implied volatility is expanding? Well, a couple different ways. One, if you're using TOS, you can look at our implied volatility indicator, and you can see if that's going up or down. If it's going up, that means implied volatility is expanding. If you're on Tastyworks, which they also show IV rank, IV percentile, but we're not able to put our indicator on that platform yet because they haven't released their custom indicator language. But the other way to think about this, and let's just simplify it to make it really, really easy. If stocks are going down, if the S&P is going down, if the market is going down, then typically implied volatility is expanding. If the market's going down that day, it's a good time to put on these weekly income iron condors because that typically means that implied volatility is expanding. So here's a screenshot of inside TOS. We're looking at 7 days to expiration on this option chain. And you can see we're going to sell the 40 delta. In this case, whatever's closest to 40. Okay, in this case, we're looking at 41, which would be the 29.40 strike on the call side. And then we're going to buy the 10 delta wings. In this case, it's at 11 delta. And that's the 29.95 strike. So those are the calls. And then on the put side, same thing. 40 delta would be the 29.10 strike. And we're going to buy the wings at 10 delta, which would be the 28.20. So this is what it will look like when you take it over to the Analyze tab in your trading platform. Okay, now a couple things to notice here. One, I've set the price slices. And we've set our calendar to the expiration date, which in this case is 7/4. And so this was on June 26th when I took this screenshot. You'll notice there's about a 50% probability of profit if we held this all the way to expiration, right? The other thing that you'll notice is when we're choosing the 10 delta strikes to buy our wings, you'll notice that those are not equal distance away from the short strikes, okay? And that's by intent. So we're trading these based on the delta, not equal distance away from our short strikes like we do a lot with our monthly iron condors. The reason is because we want this P&L, this profit line, to be very evenly distributed to the upside and evenly distributed to the downside, a very nice flat kind of bell curve looking profit line. So to do that, we're using the deltas, not an equal distant number of strikes. And so we're selling the 40, buying the 10 on the put side. We're selling the 40, buying the 10 on the call side, and that gives us that even distribution. So yeah, we have more risk on the downside, but we're going to talk about how we manage these trades. And so that's what it's going to look like when you take the visual risk profile and analyze that trade. Okay, we're getting a $31.55 credit, which equates to a max profit of $3,155 on this example. Let's move on. How do we exit these things? This is, again, based on the pricing of these. We're going to manage these differently than we do our monthly income iron condors. Okay, these are weekly. Everything's different. You got to manage these different. And so here's how that works. On the exit, we're going to exit one of two ways. We're going to exit if we get to a loss that equals 50% of our initial credit or 50% of our max profit. Okay, initial credit and max profit, that's the same thing. Okay, so our stop loss is if we get to a point of being down on the trade. We're not managing at 50% of max profit. We're managing if we're at a loss that equals 50% of that initial credit. Or we're closing at 1 day to expiration. We're not going to let this expire. We're not managing at a percent of max profit. When we get to the point where we have 1 day to expiration, and that could be right before the market closes, right the day before the last trading day, or it could be the morning of the last trading day. Either one of those is fine, but we're going to exit at 1 day to expiration, whether it's a winner or a loser. Now, I know this is going to be music to a lot of people's ears. No adjustments and no rolls, okay? We are putting these on, and then we're taking them off if we get to a point of our theoretical exit point or our stop loss, or we're exiting with 1 day to expiration. We're not making adjustments. We're not legging out of these. We're not closing one side. We're not doing any of that. It's just no adjustments, no rolls. You're going to get in and you're going to get out. The other thing I want to point out, it's very, very important. We do not use hard stop loss orders. So if we enter this trade, we're not entering a hard stop loss at this price. We're going to exit manually when price gets around that theoretical stop loss point. So keep that in mind. When we trade options, we don't ever use stop losses, okay, when it comes to actually putting the order in your system. This is a theoretical number that you're going to have in mind after you put the trade on. So let's go to the platform and let's just put one of these on. I showed you the screenshot, but I think it's helpful for a lot of people if I actually put one of these on for you just to kind of walk you through it. So we're looking at 7 days to expiration. So that's the cycle that we would choose. We're going to go down to the near the money options. These are the calls on this side. And so we're going to choose the 40 delta. You got 37 or 43. So you can either go closer to the money or further away. That's your preference. The closer you go, the more max profit you're going to have or the higher credit you'll receive. If you go strike further away, you're going to have a little less max profit, but your probabilities are going to be a little bit better. So in this case, let's just use the 37. There's no right or wrong way to do this, but we're just going to sell Iron Condor. And then we got to change our strikes, right? So that's the 40 delta, around the 40 delta, and then we need to buy the 10 delta as far as our wing, which would be the 30.35. So we change the one we buy on the call to 30.35, and then we could do the same thing up on the put side. So we've got the 39 delta, that's close to 40, and that is the 29.85. So we're going to sell the one we have showing a negative. We're going to sell that, and that's the 29.85. And then we go up to the 10 delta. That's the wing we're going to buy. It's the 29.35. So we change our long put to the 29.35. Okay, and that's it. Then we can right click and we can click Analyze and pull this over the Analyze tab. So it looks just like the one that we just showed you on the screenshot, but that's what it's going to look like from a kind of a visual risk profile perspective. Now, let me clarify the stop loss again, because on our live broadcast, we had several questions about this. You're collecting a credit of $14.55. That means your max profit is $1,455, right? So let me bring over my calculator. And just to make sure that you understand this crystal clear, we're not managing this at a percent of max profit. We're using 50% of the max profit as our loss amount. So if you get in and you get filled at 14.55 times 1.5, because that's 50%, you're getting your credit plus 50%, equals 2182, let's call it. So remember, when you sell an iron condor, you're selling to open. You're getting a credit for this amount. So if it's going against you, the value of that trade is going higher. That means you're losing money. So if you enter at $14.55 and it gets up to a point of about $21.80, that is when we're going to get out of the trade. Now, I like to start looking at this, if we get to a point where about 30%, so let's say we get to a point where it's at about $19, I'm going to kind of have my finger on the trigger, so to speak, and be considering getting out of this trade. So anywhere kind of in that 30 to 50% range of that initial credit is where I'm going to, and if it gets to that 50%, I'm out, right? I'm bailing on the trade, and I can just re-enter a new centered one if I want, or I can wait till the next day or do whatever you want. But that's kind of the hard number. If we get to that 50% loss of that initial credit, that's when we are getting out of that trade. And of course, as I mentioned before, the other piece is if we get to 1 day to expiration, then we're closing that out. We're not taking off the untested side. We're not adjusting. We're not rolling. We're not doing any of that. We're getting in and out. So that is our weekly income iron condor. Here's a recent trade. I wanted to show you this as an example just because I think it's interesting and it'll kind of give you a little bit of flavor for how these things move. And so here's the example. We entered this one on June 25th, 2019. And you can see the day I took this screenshot, it was June 28th. So 3 days later, it was on a Friday, and the expiration was on July 2nd. So at this point on Friday, I took this screenshot. We had $800 in profit. Our profit line was right here. Price was dead centered on the spread. And the last trading day was Monday. Okay, so it took the screenshot on Friday. We were up $800, but the last day of trading in this cycle was Monday. And the max profit was $3,095, right? We collected initial credit of $30.95. Look how much profit is still left in that trade. Now, part of the reason is because implied volatility was staying a little bit high because there was the G20 summit between all the world leaders. There was, obviously some consideration of what was going to happen with that. The market was kind of waiting before they contracted the premium. And so that was the situation, and part of the reason why there's so much. But in that case, I'm not going to take this off on Friday. I'm going to go ahead and let it go, and let's see what happened. Now, I was hoping what would happen is that it would just stay, in this range, and we'd book a nice profit, and I could show you, hey, guys, look, cool, I booked $2,500 in profit, but that's not what happened. And so I want to show you good, bad, ugly, everything about this. And so what happened is, if you remember, if you're trading during this time, you know that Sunday night and then Monday morning, the market opened up, the S&P opened up about $35 higher. And that was because the U.S. said that they didn't plan on issuing any new tariffs on China, which I'm not sure that's necessarily the best news. Not that we were reducing any tariffs, but just that we weren't issuing any new ones. And then Trump did meet with the leader of North Korea. So the market looked at all that stuff as bullish and shot up. And so price moved all the way up here. We ended up closing for a small profit. Market actually went down later in the day, so we could have actually closed out for a couple $1,000s, but you don't know that ahead of time. You've just got to stay mechanical. So anyway, we booked a small winner on this trade and just got out of the trade. But look what happened. I took this screenshot first thing Monday morning, the last day of trading, based on where it was on Friday and then where it was on Monday morning first thing. It shot way up. Of course, price didn't accommodate, but we still got out with a little profit on the trade. So I just want to show you this to get you to understand kind of how these things can move and some of the considerations you want to make when being in these trades. The other thing to keep in mind from a risk standpoint is, and I'll talk more about position sizing later on in the presentation, later on in this course, but the one thing you want to make sure you understand is when you put this on, you better be ready to take a max loss, okay? So you need to trade small enough so that's not going to blow your account out, or do anything crazy. We want to trade super small with these because if there is some type of black swan event or some huge movement overnight, it could go past that theoretical stop loss that we want to get out at for losing trades. I mean, think about this. If anyone was trading in 2011, September 11th, 2011, what happened that day? Very historic moment in the United States where there was an attack on the World Trade Centers and the Pentagon, And what happened that day, I was trading, and what happened was when that happened, the markets closed. And they closed for several days, and then when they reopened much lower. So if you're in a trade like this, you're more than likely you're going to hit max loss on that trade. Now, does that kind of thing happen very often? No, absolutely not. But you're still not going to risk so much that you can risk blowing out your trade on a strategy like this. You've got to keep your position size small, and we'll talk about how to do that later on in the course. But I just want to make sure you understand that this is not an ATM machine. You still have to manage your risk appropriately.